Hi everyone! Last week was relatively calm. Investors had a chance to take a breather and analyze the market situation. Given that all three benchmark stock indices closed in the red, losing around 3%, concerns about an aggressive rate hike by the Fed had increased again. According to new macro stats, the economy remains strong despite monetary tightening. It may be a solid reason for the regulator to stick to a hawkish stance in the long term. However, the majority of investors have already priced in a 50 basis point rate hike this Wednesday. This week, the main event will be the Fed meeting. Nevertheless, a surge in market volatility may occur after the release of the inflation report. It is expected to confirm whether the inflation has finally peaked or not. Naturally, speculators are pinning their hopes on the first scenario, yet one should not rule out any possibility. Watch our video review till the end and find out the latest market news. Please leave your comment down below. Let's start. The stock market is likely to be in the bearish close in the first half of the week. Analysts expect inflation to remain unchanged. On the monthly basis, it's projected to rise 0.3%. In annual terms, the CPI is likely to grow 7.3% in November. This will be the last crucial economic report before the announcement of the key rate decision on Wednesday. However, market players are not particularly interested in the size of the cash rate increase at the December meeting. They will pay more attention to Jerome Powell's comments and the economic outlook. Investors are widely expecting a shift to a more dovish stance and a soft landing. However, last week they were again concerned about the risk of a recession in the US, which adversely affected sentiment. Thus, the Fed's outlook and Jerome Powell's speech at the press conference will be in the limelight. Traders are sure to get more clues about the monetary policy prospects after painstakingly studying Powell's statements. All three stock indices kicked off the week on a pessimistic note. They extended the downward movement that began last week, yet they made an attempt to recover. Last Friday, their sentiment turned sour after the publication of the Producer Price Index. It usually reflects the possible changes in inflation and affects long-term expectations for monetary policy. The US Producer Price Index exceeded market forecasts. The report also indicated an increase in the CPI index and the core inflation on an annual basis, so it somewhat dampened expectations that the Fed would soon slow down its aggressive tightening cycle. As investors had digested a batch of economic reports, Wall Street closed with losses on Friday. The Dow Jones lost more than 300, while the S&P and NASDAQ declined by 0.7%. Over the week, the Dow decreased by 2.8%, logging the worst weekly performance since September. As for the earnings season, DocuSign stock gained more than 15% amid better than expected quarterly results. Lululemon shares sank by 12% following the publication of weak revenue forecasts for the fourth quarter. This week, traders will take notice of Oracle and Adobe IT earnings reports. Judging by the results of last week, market players are still betting on a shift to a dovish stance. It means that bullish sentiment may finally prevail this week. If so, indices will recoup their losses rather quickly. Now traders hope that inflation will finally begin to steadily decline. Besides, speculators saw the first signs of its fall in late October. If the CPI slides again in November, it will certainly be excellent news for investors. It will also renew hopes for the Santa Claus rally. Otherwise, those investors who did not diversify their portfolios or hedge their funds could incur significant losses. If inflation climbs, there could be a large-scale sell-off on Wall Street. The S&P 500 index shed 3.4% last week, dropping below 4,000. This is a clear sign of a further downward movement to 3,840 and below. Investors have been rather hesitant when opening new positions for almost a month. As clearly seen on the chart, the index has been lacking the driving force to climb higher since November. Trading volumes were also moderate. The index retreated to the lows after Thanksgiving. It appears that traders are now reluctant to make any effort to push the price higher. They seem content with the situation that the index has not fallen lower. There will hardly be any changes until the release of CPI data and the Fed meeting. Only these two events may spur up market activity. However, there is a chance that the reaction might also be rather subdued. Apart from all the pessimistic factors, there were also positive ones last week. For instance, demand for stocks of leading semiconductor companies and communication service firms jumped. The shares of the companies from these two sectors showed an intraday increase of more than 1%. Tech shares advanced by 1.7% on average, and communication services stocks added 1.4%. Shares of energy companies decreased again. Investors had been locking in profits by closing positions on those shares for the whole week. Given a strong drop in the S&P 500 index, analysts believe that the price has already reached a short-term peak. This assumption will be accurate if the index slides below 3,930. After that, there could be a decrease to 3,840. This is the correction level of the October-December rally. The index may be hovering at this level for some time. Eventually, it is expected to approach 3,835 and then 3,775. So the underlying scenario suggesting that the October-December rally took place in the bear market is likely to be confirmed. The nearest resistance level is located at 3,985. Bulls may be unable to push the price above the range of 3,999–4,015. However, if they succeed, the index may recover to 4,050. NASDAQ 100 fell by 4% last week. This week will be decisive for its future trajectory. The Fed's rate decision and Powell's speech at the press conference will shape the main trend in the stock market until the end of the year. Oftentimes, a decrease in inflation was followed by a new rise. Hence, speculators need more signs that inflation has peaked. Now it remains extremely high, making investors anxious. It means that their dovish expectations may again be false, which could lead to losses. For what it's worth, they will find out the truth this week. Recently, there has been lots of news about Microsoft. The company is known for its controversial deals which lead to antitrust battles with government regulators. Reportedly, the Federal Trade Commission filed an antitrust lawsuit last week in an attempt to block Microsoft's $69 billion acquisition of video game company Activision Blizzard. Rival PlayStation maker Sony has been lobbying regulators in an attempt to curtail Microsoft's plans. If the deal is concluded, Microsoft could suppress competitors to its Xbox gaming consoles and its rapidly growing subscription content and cloud gaming business. On Monday, Microsoft announced that it would acquire a 4% stake in the London Stock Exchange Group. Under the long-term deal, London Stock Exchange Group committed to minimum cloud-related spending $2.8 billion with Microsoft. Microsoft stated that the basis of the partnership would be the digital transformation of London Stock Exchange Group's technology infrastructure in Refinitiv platform onto the Microsoft Cloud. London Stock Exchange Group shares rose by 4% at the beginning of trading. Microsoft stock also jumped higher. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you.